All right, let's put on our investor hats for a few minutes. Today, we're giving Halcyon Agri a full financial health checkup based on their latest annual report. We're going to look at the vital signs, the good, the bad, and the pretty concerning, to really understand where this natural rubber giant stands and where it might be headed. Let's dive in.
So first off, who exactly is Halcyon Agri? Well, to put it simply, they are a massive player in the world of natural rubber. Think about what goes into car tires, medical gloves, and 1,000 other things you use every day. Halcyon is right there in the middle of it all, a really critical link connecting rubber plantations to the world's biggest manufacturers.
So, to keep our little medical checkup theme going, here's our plan. First, we'll look at the symptoms. That's the top-line financial results. Then, we'll move to the diagnosis to figure out what's causing them. After that, we're going to check the company's underlying vital signs before finally giving a prognosis on the risks and opportunities that lie ahead.
Okay, let's start with those symptoms. What do the big headline numbers from 2025 really tell us? Well, the first one is, it's a doozy.
The first, and honestly the most striking symptom, is a 41% drop in gross profit. Whoa, that is a huge red flag. See, gross profit is a core measure of a company's health. It's the money left over from sales after you pay for the product itself. When you see a drop this sharp, it immediately tells you that the basic business of buying and selling rubber is in some serious trouble. And of course, that drop in gross profit, it trickles all the way down to the bottom line. The company ended up posting a net loss of nearly $100 million for the year. And just to put that into perspective for you, that's more than triple the $30.9 million loss from the year before. So not only is the company losing money, but the speed at which it's losing money has just massively accelerated. This table really just lays it all out, doesn't it? Take a look at that top line, the revenue. It was basically flat. You might see that and think, okay, well, that's not so bad. But then your eyes move down the chart. Even though they brought in pretty much the same amount of money, their ability to actually make a profit from it just completely collapsed. You see, the problem wasn't selling rubber. It was making money from selling that rubber. So, those are the symptoms. Now for the diagnosis. Why did their profitability fall off a cliff like that? Well, the report points to what was really a perfect storm of factors. Okay, so first, a weaker global economy meant weaker demand, and their actual sales volume fell by almost 11%. At the exact same time, the cost of the raw rubber they need to buy went up, squeezing their profit margins. And finally, here's a bit of a curveball. A delay in the European Union's new anti-deforestation rules meant that a price premium they were expecting to get for their sustainable rubber, well, it just didn't really happen. It was a classic case of getting squeezed from both sides. They were selling less and making less on every single sale. A tough year is one thing, right? But what about the underlying financial strength of the company? For that, we need to peek at the balance sheet. This is like checking the company's vital signs to see how resilient it really is. And this first vital sign, it's definitely concerning. We're looking at total equity. That's basically the company's net worth. It's what's left for shareholders after all the debts are paid off. And as you can see, in a single year, it was nearly cut in half. That is a massive loss of value for anyone holding their stock. Now for the next vital sign, and this one points to a really serious cash problem. The company is in a position of net current liabilities. So what does that actually mean? In simple terms, it means its debts that are due within the next year are over $520 million more than the cash and other current assets it has on hand to pay them. This raises a pretty big immediate question. How on earth are they going to cover their short-term bills? And that situation leads us right to a critical accounting concept called going concern. It's basically the assumption that a business will be able to stay in business, that it can keep the lights on. When a company has the kind of short-term debt problems we just saw, that assumption suddenly starts to look, well, a little shaky. So how are they planning to pay their bills? Well, the answer is right here in this quote from their own report. They're relying completely on the full support of their two biggest shareholders just to stay afloat. Now, for an independent investor, this is a gigantic red flag. It means the company can't stand on its own 2 feet financially. It's totally dependent on a bailout from its parent companies to survive. So, given this diagnosis, what's the prognosis? What does the future actually look like? The report lays out both a potential path to recovery and some pretty significant hurdles that are still in the way.
Okay, so it's not all doom and gloom. On the bright side, there are real opportunities here. That European Union deforestation rule, the EUDR, it's still coming. Demand for sustainable traceable rubber is only going to grow, and the report says Halcyon is well-positioned to meet that demand. On top of that, their main customers in the car industry are expected to see stable growth, which should help demand for tires.
But, and this is a big but, the risks that caused all the problems in 2025, they haven't gone away. The global economy is still very uncertain. Those high raw material prices that squeeze their margins could easily continue. And there's a new threat on the horizon, the possibility of increased U.S. tariffs, which could hit demand for their products even harder.
So, what's the final word from this financial checkup? Well, Halcyon Agri is really at a crossroads. It has a genuine opportunity to be a leader in the growing market for sustainable rubber, but at the same time, it's facing serious financial headwinds, and is, right now, dependent on its major shareholders just to stay in the game. It's a classic story of risk versus reward.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.